To talk us through the PNI numbers, Jackson Hole, the summer, obviously everyone was thinking about this rally was a bit abnormal.
And Ulysses.
And Jackson Hole and now the China slowdown, does that kind of paint that picture that maybe summer is over now?
Yeah, the summer rally absolutely has come to an end. I think it's more likely we revert to the underlying macro and market conditions that characterized the first half of this year. The reverberations from Jackson Hole will continue for some time. We are seeing it, frankly, in renminbi. We're seeing it reflected in weakened demand in the United States, but in particular the EU as well.
Yeah.
And for as long as we get this sense that the Fed is fixated with a laser focus on bringing inflation down to that target area to 3%, my sense is the markets will remain on the back foot.
So what does this really mean? I mean, are we heading towards perhaps setting the groundwork for a policy error? I mean, is that on your radar?
It's certainly a risk, and it's one that needs to be taken very seriously. The Fed have the preeminent risk in their mind of allowing inflation to remain unchecked. So right now we have echoes of the Volcker moment in the late 70s, early 80s, where inflation was grasped and tackled aggressively. Fed Chairman Powell seems to be channeling his inner Volcker right now and seeking to communicate to the market his determination and aggression in driving down inflation. And of course, that's why markets have so aggressively repriced as they disabuse themselves of this concept of the pivot. That is a fantasy. Right now, inflation is the single most important policy target for the Fed. And frankly, there will be fallout both at the economic level and in markets as well.
But then, you look at energy prices, look at the UK and Europe here as well, and, when you're having a look at those, these are huge increases. I mean, and then you've got governments, would you believe it, giving money back to the people in order for them to be able to pay their bills. At the same time, got an ECB tightening. I mean, that in itself, energy prices going up by the magnitude that they are, is an interest rate hike, and quite a sizable one.
It's absolutely a form of monetary tightening, and let's not forget quantitative tightening as well in the United States. That similarly will reverberate around the global economy. The price hikes are more of a supply shock derived, and I don't see that changing anytime soon. So yes, we have got, I think, ourselves a challenging 3 to 6 month period. And by the way, one of the key reasons why we at Credit Suisse elected to revise lower our equity recommendation from neutral to underweight earlier this week, reflecting, I think, heightened risks in the next 6 months and a preference for a more I think, prudent allocation of risk.
So you guys talked about going underweight, global equities. Where do you put your money now then?
Well, we're still focused on opportunities in the private sphere in particular, but more broadly alternatives, which is an area that we're particularly focused on. It provides some protection from the volatilities of public securities, and it's something that our clients welcome. But we also see selective and discrete opportunities in the fixed income space. For example, the yields now on hard currency emerging market bonds are looking a little more attractive. And still we're looking at selected opportunities, particularly for our so-called super trend themes, which are these multi-decadal investment strategies which provide exposure to what we believe are some of the most important thematics driving the global economy right now.
The trouble is that's going to be also predicated on what you think where the dollar's going.
Yeah, well, look, right now...
And you've got to hedge against that. And how do you do that?
Indeed, right now, look, the only way I think for the dollar is likely higher, given right now it seems the Fed is the only major game in town. It's quite possible that the ECB will surprise us to the upside in the next few days and hike substantially more than maybe the market's anticipating. And certainly inflation metrics out of Europe in general, Germany in particular, suggest that's important. But I think upward pressure on the dollar is likely to remain a feature for some time. And of course, clearly we're feeling the effects of that in the Asian currency complex right now.
And I have to wonder, if we're looking at any kind of catalyst for you to get back into equities, what would it be? Is that we need to see inflation come down to maybe 5%, and maybe the Fed will be more inclined to pivot and cut rates next year, or what is it that you need to?
Well, I think certainly some investors will be very focused on valuations. My sense, if valuations in the United States were to get down to sort of 2, possibly more standard deviations below a long-term 10, 15-year mean, it might attract value hunters. But our overall context and focus is seeing inflation at or very close to the Fed's 2%, 3% target, and not only touching that, but actually remaining there for a reasonable number of months. And at that point, I think we can actually anticipate a pivot. And then I think, of course, it will be an equity story once again. I don't think we're going to get there for the next 3 to 6 months.
Well, even further, do you think could it be a year before we get, have to go from 8% to 2% and stay there? So that means you stay out of public markets, generally speaking, for more than 6 months.
Well, we remain underweight, and how long it'll take will depend on whether inflation is transitory. It appears not to be. And the more sticky it gets, particularly on the services side, and I'm talking obviously about wage pressure, I'm talking about housing costs, then I think it becomes a slightly more enduring problem. Our sense is that, come the second half of next year, we will be approaching that target. We've already passed peak inflation. Let's be clear. Inflation has already peaked. It's already trending lower. But I don't think it's going to be a straightforward transition. I think it's actually going to take quite some time. And the inflationary implications of that suggest that, again, a second quarter event is probably the more likely target.
Yeah, it strikes me that we do look at inflation as something unitary, but the structure of inflation is changing. We've got deglobalization, on top of that green inflation, and then demographic challenges as well. So it becomes a harder nut to crack. Yeah,
there's likely to be something of an enduring premium that we have to live with post-COVID. I think that's highly likely. Right now, I think the Fed are fully focused on the risk of inflation as being public enemy number one. They are looking to drive that down. That was the message from Jackson Hole. And if there is something of a 50 basis point, maybe 100 basis point premium to inflation after that, it's going to be tomorrow's problem. Right now, the focus is getting inflation down to target.
So what do returns look to you, say, over the next 5 years? If we're suddenly back to normal inflation, we have to bake in that premium again that we haven't baked in really for 15 years.
I think there's going to be a period of dislocation, David. I genuinely think that looking forward over the next 1, 2, 3 years is going to be something of a volatile period. We've had low rates now for 15 years. We've had house prices shooting higher. We've had asset prices, both bonds and equities, substantially higher than those even GFC levels. So my sense is we're going to need to see some sort of rebalancing and probably a disruption of some of the pricing that we've been and drawn accustomed to. So again, the importance of an actively managed, diversified portfolio, one in which we have a reasonable exposure to the major asset classes, is I think the likely strategy which will outperform over that.
How does China fit into that whole strategy for you now?
Well, China clearly is of critical importance to investors that have a home bias, that have a particular preference for and focus on North Asia. Right now, China obviously is grappling with a slowdown of some generational importance, and trying to engineer a way out of that, as we are hearing, is quite challenging. I think hopefully we can get to see some clarity after the People's Congress, particularly relating to zero COVID. And I think once that happens, we will maybe unblock some of the logjam that has prevented and made more hesitant the investment in infrastructure and the use of that stimulus for spending, which will, I think, provide something of a growth fillip. But right now, the China story is really contingent on policy support, if you're an investor. And right now, there's that hesitancy in policy support, which is, I think, holding the equity story back.
Europe equities? I mean,
Europe is a big challenge right now. I think there's absolutely almost a certainty of recession in Europe. Inflation is proving to be substantially harder to manage. I think that the ECB really do have to step up and surprise markets to the upside, maybe a 75 basis point hike in their next meeting. Quite possibly we have this enduring recession from the supply shock due to energy prices. Right now it's a very challenging story for investors, and for that reason we remain underweight.